The former Treasury Secretary Larry Summers is warning of a looming recession over, quote, surging inflation. The Personal Consumption Expenditures Price Index, PCE index for short, just hit a 40-year high. Inflation is here, folks. But you didn't need a fucking report to tell you that, because Dollar Tree is now taking things up beyond $1 for the first time in their 35-year history. And even if that was news to you, you have certainly noticed prices are going up everywhere. So what asset classes can we as investors go to for higher returns during inflationary periods? This chart published by BlackRock shows us the average total annual return by asset classes in different types of inflationary periods, which is a much better comparison than simply generalizing all periods of inflation or looking at total real return, which is the total return of an asset class beyond inflation over a long period of time. When we look at this chart, we can see at the bottom that high growth periods are classified as periods when the US GDP growth is greater than 2.5%, and high inflation is when the US CPI is increasing faster than 2.5%. As you would expect, in a high growth, low inflation period, stocks are the asset class to be in, with average annual total returns in these conditions above 20%. And we've seen this play out over the last several years. In a growth in high inflation period, as we have been in for 2021, real estate and global infrastructure have been the asset classes to be in. This chart was based on data through December 2020, so that gives us a year of out-of-sample data to check out. Interestingly enough, real estate has done incredibly well this year, with the Vanguard REIT ETF returning 35.75%, while the S&P 500 returned 29.19%. Not a shabby year for either of those two, really. And then there's global infrastructure, which has historically returned almost 15% annually during prior years of similar growth and inflation, as this BlackRock chart shows us. Represented by the iShares Global Infrastructure ETF, has returned only 9.39%. So global infrastructure hasn't exactly held up in this high growth, high inflation period. Of course, we couldn't avoid looking at the good old boy inflation hedge of gold. A lot of people seem to think that gold is the best inflation hedge. I don't know why. That really couldn't be further from the truth. This chart here from Visual Capitalist shows us that while gold did crush it during the inflation of the 70s, with a return about 3.5 times inflation, it actually had negative returns during the inflationary period of the 80s. So going forward, where does that leave us? Well, to me, it is clear that no two inflationary periods are the same. Different things can happen in different periods of inflation, just as we see with recession, right? Before the March 2020 recession, I know it was short-lived, nobody predicted that a virus would cause a recession, nor that high-growth tech stocks would become the safe havens. But they did for the year of 2020 and that little recession that we had there. Considering that, the best time to prepare for inflation was a few years ago with a diverse portfolio. Absent that, we can see that clearly cash is not king. Anything in cash is just a loss, and you are statistically going to be much more successful if you have your money invested in some type of appreciating asset. So if you want to try to capitalize on inflation, increasing exposure to REITs doesn't seem like a bad idea, considering the momentum that it's had this go around in its past performance in similar inflationary periods. Just remember though, investing is risky and predictions do tend to be wrong, so keep your exposure to whatever you consider a safe amount, right? Don't go all in on one, specific asset class because you think it's going to outperform inflation. Now, if you do decide to increase your exposure to REITs, when do you get off the train? Personally, I need to have a quantitative rule for exiting everything that I get into. And there's two possibilities that I see with this. One possibility might be when we have 2 consecutive quarters of declining inflation. That signals simply that inflation is no longer growing, right? And inflation is declining. Another possibility might be when the 6-month total return of REITs is less than the 6-month total return of the S&P 500 or T-bills, right? Or, maybe you could go a little bit more strategic and go half and half, right? Reduce your exposure to REITs when the total return becomes less than the S&P, 50%, and then reduce it another 50% or the remaining portion when it goes less than T-bills. And, there's no rule that says it will go in one order or the other with those. So on that note, how are you positioning your portfolio? Are you making any tactical changes for this period of inflation that we're coming up on? Let me know in the comments below.